Hello, everybody. Good morning, and welcome to another webinar from CW Group. Once again, due to COVID, from my home to yours. So today we would like to share with you some of the insights on the global chemical industry. And to start off, I just wanted to give a brief introduction to myself. My name is Prashant Singh. I'm the Associate Director of CW Group here out of Mumbai, India. And I will be sharing with you some of the insights today about the industry from our perspective. So on the agenda today is a brief introduction to our company, and then we'll launch into sort of the economic overview, and then some insights on the global chemical industry, and possibly those sectors or sections of the industry who stand to benefit most, and what it means for some of these other regions. So let's begin. Please bear with me for those who sort of have already heard this spiel before, and for those who haven't, I'll try to be brief. CW Group works under three different verticals. We have the advisory vertical, research vertical, and media vertical. Under advisory, we work with major global consultancies and leading institutions, including the World Bank, as well as several sovereign wealth funds on different projects. We provide consulting and advisory expertise on a diverse product portfolio. And during these challenging times, we have helped multiple industry participants on their decision-making processes, including projects based on the feasibility studies in the Horn of Africa, market assessments in South America, and market entry strategies in the Middle East. Within the research vertical, CW focuses on producing syndicated reports, and those reports generally cover areas like cement, building materials, petcoke, bulk shipping, and paper and pulp. We are well known for our studies on cement demand, as well as detailed industry and country reports. A premier feature of our reports include historical series, as well as a 5-year forecast. And some of our trademark products include the volume forecast report, trade prices report, and the white cement report. Under the media umbrella, we have an online database. We provide newsletters focused on cement, building materials, coal and petcoke, as well as on shipping and paper and pulp. We also hold industry-specific meetings called CW Summits, and those are scheduled at various times of the year. And for more information, please contact us post this webinar. So let's now launch into the insight section. So here we see certain numbers from the IMF, World Bank, OECD, and which have just recently been released in the month of June. And as you can see, even the IMF had in April set the global contraction at 3%. And in June, they have actually revised it to almost 4.9. The World Bank has also generally a much more dour statistic, has put it down at 4.2%, 5.4%, and the OECD is the worst outlook at minus 7.6% globally. Just to put that in perspective, that's an unheard of figure. I mean, we would have been shocked, or anybody would be shocked if they had put that in terms of a positive growth. So when we're low in terms of trying to understand the impact on a negative scale, Of course, the distribution and the pain of this is definitely uneven, but what this does signify is that there is no V-shaped recovery. And I think the best we can actually hope for is a long U-shaped recovery. And traditional market drivers outside of North America and Europe, China and India are facing a multitude of challenges, politically and economically, and let alone over the past few weeks that these two neighbors have actually been involved in some heated exchanges over the border. And one can only hope that after the pandemic and the oil price collapse, we do not have a regional war between the two most populous countries and some of the biggest economies in the world. So it's a very challenging scenario, to say the least. Next slide, please. In terms of the fact that when we look at the data, it seems to get progressively worse every passing week. The global economy is facing actually unprecedented challenges, and I know that's a term that has been thrown out a lot over the past few months, and this has not happened at least since the Great Depression. The level of economic, social destruction that we have seen wrought as a result of the pandemic in just the 6 months of this year is a mixture of sort of the suffering that I would say not we, but the world witnessed during the 1918 influenza, which is the last global pandemic, and a mixture of the economic suffering during the Great Depression. And unfortunately, we do not have an any end in sight in terms of the getting out of this turbulent period. Most people say that any vaccine will only be available until early or mid next year. So one can conceive that this is going to drag on a bit. And if you look at the numbers and statistics coming out of the US, there is actually no sign of sort of an abatement as of yet. So the situation remains very, very, very challenging, to say the least. Next slide, please. So in terms of what has an impact on sort of global, global chemical industry, I wanted to sort of give you a historical perspective of, in terms of where the industry stands as of now. So and then this is recently released data as of like 2017. So in terms of what we see on this chart, the total GDP from the chemical industry was close to around $1.1 trillion. And when we sort of contribute the GDP contributions of allied sectors, this increases to almost $6 trillion, which is sort of more than equivalent in the GDP of Japan. When we look at the fact that the industry supply chain spending also stimulates high levels of employment. So an estimated 60 million jobs were supported through the purchase of goods and services by chemical companies in 2017 globally. In effect, for every employee that is employed by the chemical industry, almost 7 jobs are sort of created elsewhere in the global economy. So there's sort of a very concrete relationship in the success of the chemical industry and sort of growth. Now, it's very interesting in terms of the diversity of wage. An average annual labor cost can range from $144,000 in Belgium to merely $5,000 in sort of Vietnam. So as you can see, the magnitude of difference is enormous. Next slide, please. It should be of no surprise to anybody that the Asia Pacific chemical industry makes the largest contribution to GDP, or made the largest contribution. It accounted for around $2.6 trillion worth. It sort of generated 45% of the total industry's economic value and accounted for about 60% of the employment generated. After that, you see Europe, followed by North America. And when you look at Africa and the Middle East, majority of this GDP contribution in that region is from the GCC. As always, and for many different industries, India and China continue to drive the growth in the Asia-Pacific region, with India's focus on specialty and fine chemicals, a key market segment of interest and driver over the next few decades. Next slide, please. So beyond basically just what the industry looks like, who are the other sort of affected parts? The biggest industrial users of chemicals are rubber, plastics, textiles, construction, computers, and electronic manufacturers, as well as paper and pulp producers. In effect, almost 58% of global chemicals that are sold downstream go to other industrial sectors. In 2017, the entire chemical industry generated a gross output of around $4.1 trillion, out of which $1.1 trillion was the gross value add. And if you look at across the non-chemical sectors, the supply chain spending of the industry, it was expected to have contributed around $2.6 trillion to global GDP in 2017, out of which roughly half came from the Asia-Pac region, and basically which equates to the entire GDP of India, which is now the world's fifth largest economy. The entire chemical sector spent around $3 trillion on goods and services from suppliers across the world, and out of which there is an estimated around next slide, please. So when we're looking at this slide, the key takeaway that I wanted to share with you is that only 4 regions generated a chemical surplus with the world in 2017, which included the EU, the US, Japan, and the Middle East. And these regions performed well because they generated a net export. The EU by far has the largest chemical surplus in the world. And the EU is the only region to have a trade surplus with almost all regions, with the exception of the Middle East. The United States is the second largest surplus, while the rest of Asia has the largest chemical deficit in terms of value. And in absolute terms, Latin America has the biggest trade deficit, followed by Africa and Oceania. And so what that really does mean is that the reason why the Asia Pacific region is the center for growth and demand is that these regions do not have the sufficient chemical infrastructure or facility infrastructure yet, and so they are dependent on trade from these regions. Next, in terms of sort of the export markets, we see that almost a fifth of US chemical exports are destined for the EU chemical market. And the rest of Asia Japan, China, and the Middle East excluded, and Latin America are respectively the world's second and third largest exporting regions for the US chemical sector. Whereas market is the largest destination for Chinese products. And almost 46% goes to rest of Asia, and only 13% goes to the EU. In totality, China accounts for roughly 15% of global chemical exports. So, I mean, this is probably a very basic slide, but what we want to sort of highlight is the fact that the position in the chemical industry value chain is a major determinant of the gross value added. While petrochemicals are at the start of the value chain, and this is defined by high plant intensity, but low R&D investment as production processes, as well as the final outputs have already been tried and tested. So it's not anything revolutionary. When we move towards the specialty and fine chemicals section, this requires a significantly more investment in R&D. And it's to no one's surprise that the EU and North America are the actual leaders in this field due to historical sort of dominance. However, when we look at in terms of expenditure, the entire chemical industry spent around $51 billion in 2017 in R&D. And China was the largest chemical expenditure, had the largest at around 14.6 billion, and followed by the US and Japan. Whereas especially led by Germany had around like 4.4 billion. So, I mean, obviously China is trying to play catch up to move into that field of dominance that European and American companies such as BASF and DuPont have established. But it's going to take some time, and that's why you see the heavy expend. Next slide, please. So what does this mean in terms of possible benefits? So over the course of the last few months, we've seen historical decline in oil prices, even though they've recovered. But this gives us some valuable insights as to where things or which companies and countries and regions can benefit from. So many chemical companies that have seen their earnings deteriorate due to COVID's impact, and consequently sort of the overall decline in the demand for chemicals. The chance to lower their crude oil-based raw material purchase costs is a definite lifeline. And since raw materials are a key costs are a key driver for product profitability, from upstream petrochemical makers to specialty chemical companies, which includes everything from adhesives and sealants, paints, coatings, and soaps, etc. In many cases, the downstream company's raw material will be the end product for an upstream chemical company. And a lot of the purchasing procedures is based on sort of an index-based formula. And these formulas automatically reflect the movements of sort of crude oil, although oftentimes with a time lag of weeks and not months. And if COVID, the pandemic and the dramatic collapse of oil price due to price war has taught us anything, time lags of weeks and months is no longer sort of the normal. This is a much more faster evolving world. So in the current market, if companies want to sort of adapt, they need to negotiate more favorable terms from their suppliers They need to routinely scour for substantial discounts based on formula-based pricing because they're able to therefore negotiate across different suppliers and not be sort of focused on only one. Companies have the opportunity to sort of look out for bigger discounts and lock in much more attractive purchase pricing by getting a pricing formula based on upstream feedstock costs or getting the supplier to sort of agree to a fixed price. Meanwhile, for like norm formula-based purchases, procurement departments must make sure that the fall in prices and the market supply-demand conditions are reflected at once in the prices that they're paying for these raw materials. So gone are the days where you would be content in sort of indexing based on the future price for oil over months. It's basically now they have to do it on sort of a very, very near-term basis. It is obviously much more challenging, but given the context and given sort of the rapidly evolving situation across the world, it's almost a necessity now. A 50% drop in crude prices has the potential, if taken proper advantage, of contributing between 2 to 4 percentage points in EBITDA. For companies whose raw material spend is equivalent to around 10 to 20% of revenues. That's considerable when you're sort of thinking about it holistically by sort of, one would almost call it business process optimizing, right? So because this is not something revolutionary, but you're sort of rearranging the way companies are doing a particular indexing. And experts recommend that now it's a great time to sort of adapt and change if we are to survive and be viable. Next slide, please. In effect, just to sort of conclude, large-scale price they have occurred due to wars, natural calamities, for various reasons, and they will continue to do so. Can we predict them? No, but we can sort of now understand how to take advantage due to sort of recent historical ups and downs, even as early as late, the last time crude prices crashed were in 2014 to 15. So this is not unprecedented. It's only 5 years ago. So there's a lot of data that can be used to adapt and apply. Value addition is no longer sort of a luxury item. It's imperative to remain competitive and viable. Asia and driven by China and India will continue to be a driver for growth, while technological leadership for the time being will remain in the EU and North America. Now, what does that mean? For regions like Latin America, Oceania, and Africa, they need to reassess, countries in this region need to reassess the existing stage of their chemical industry development. For example, a country like Brazil needs to sort of reevaluate how they have been doing, the kind of investment they've been doing or not doing in terms of developing their industry to make it move up from basic petrochemicals to specialty and fine, which is where the future is in terms of adding value and in terms of remaining a major player or emerging as a major player in the industry. So with that, I'd like to sort of thank you all for listening, and please feel free to contact us on the details below, and we would be happy to sort of discuss with you on this topic and any other topic where you think we can help. So thank you once again, and have a great day.